So guys, I want to walk you through a couple of trades that I've done in the past so that I can reinforce some of these lessons. And I just want to remind you that this information is for your education only. Trading is very risky, so you need to read the disclaimer and understand your risk at all times. Now, back in the middle of November, I posted a trade on how to potentially make a profit with a decline in the overall stock market. So let me go through this lesson again, and I want to show you another trade that I did toward the end of February of this year that you could have taken advantage of if you would have taken action by applying what this lesson actually went through. Now, with this particular post, I had explained that there was some internal market weaknesses that I had identified in the overall market, and I was expecting a decline in the S&P/X. And what I actually demonstrated here was a relationship between volatility and the underlying market. So here you can see the black bars are actually the S&P/X. What I'm trying to show you here is when the market declines, there is a rise in volatility. So if we can forecast a market decline, then we can also profit with a potential rise in volatility. So I was expecting here that the market was going to run out of steam towards the end of November. Therefore, I was expecting volatility to rise. Now, what we did here, we actually, based on that expectation, we bought some call options on the VXX. We actually bought a spread, and then I also put up a update to that position, and you can see here that the market did in fact decline, and it declined towards that first half of December. This is 2014, and we also therefore saw a rise in volatility, and this allowed our options to rise in value, allowing us to profit. Now, this position we purchased call options for only $290, and this is all detailed in that original post. And once we saw that rise in volatility, we were able to actually make a profit of $1,100, nearly 400% return on investment. So very, very powerful technique. You need to apply the lessons that I teach you with this material that you have access to. Now, I did something similar using the same technique on the 25th of February of 2015. So let me move over to my chart. So you can see here a chart of the S&P 500, and the first thing that I do is I draw a trend line, which you can see it starts here in October of 2014, and it just continues off to the right hand side. Now keep in mind where this trend line is, because it's important in my lesson here. It starts here in October of 2014. Now let me make this a little bigger. Now we're talking about a trade that I did towards the end of February. Okay, so that's what I'm going to walk you through now. End of February, the trade was put on here on the 25th of February. So let me talk you through what that trade was and why I entered into this position. And it's taking all the lessons that you've learned about the S&P and volatility. Okay, so it's just another example of the same sort of trade that we've done previously that I just walked you through. So the first thing that I noticed that sort of indicated to me that there was going to be a pullback in the S&P was that with this move down, this original move down, I could see that right now the S&P 500 was a little overextended. Okay, so this move up here was a little overextended from its previous move down. Okay, so that was the first thing that I'd noticed. Now let me get rid of these so I can talk to you about the next thing that I noticed, which is probably more important anyway. And that was that at that point in time here on the 25th of February, the RSI indicator was showing to me that it was at a key level, 65. What I have noticed is when the RSI indicator is around the 65 level, then there's a good chance of a pullback. So you can see here, when I put my mouse right on this level and it's around 65, look at the bar that's highlighted on the stock chart. It's actually right on the 25th of February. So that was the second indication to me that there was a potential pullback coming, and that's not uncommon to see a pullback, back to the trend line, back to the support line. So at this point in time, I purchased some call options on the VXX, and let me show you what those call options were. I'll just switch over. And so on the 25th of February, let me just get this date correct so we can see the actual call up. I bought a number of call options to construct this position, and total cost for this position was $1,000, and I exited the position towards the middle of March, and that was because I could see that the S&P/X was trading back towards that support line, back towards that trend line. So at that point in time, here this was on the 11th of March, I had exited my position, and if I show you the results, I made a nice profit of approximately 70%. So a nice $700 profit, which is a great 70% return on investment in just a couple of weeks. What I want to say here is that you need to take advantage of the information that you learn so that you can also have these types of similar results. So watch this trend line, folks. Watch the S&P/X over the next couple of days, especially given that the last employment report last Friday wasn't so good. So if we break this trend line, then you may want to consider looking at some call options on the VXX, because the S&P/X may in fact start to break down, and we could even go as low as 2,000 on the SPX. So remember, if we see a decline in the overall market, then we should expect to see an increase in the VXX. Okay, so in my view, if we break this trend line, then the S&P/X could in fact fall all the way down to 2,000 or even down to 1980. So we could start to see a nice rise in volatility, meaning that the VXX options would increase in value. Okay? Happy trading, and always manage your risk.